So I think that's drying up the whole of the mechanism, if you like, in London. So what I'm saying is that, it's all very well turning around and saying, put 20% of your portfolio in gold. It's not there. And worse than that, the liquidity actually is drying up. The liquidity that's keeping the paper market going, because, this leased gold, it gets hypothecated, re-hypothecated, re-hypothecated. It just goes round and round and round. And my strategy, I think, would be get gold now, because there is absolutely no doubt it won't be available at anything like these prices once these things happen. And silver, incidentally. Well, I know it's not a monetary metal. If you look at a gold-silver ratio of, 83, 84, this is plainly ridiculous. It should be 30 or lower.
Veteran economist and market strategist Alasdair Macleod has issued another sharp warning about the illusion of liquidity in London's paper gold market. He explains that while financial institutions and advisors continue to recommend a 20% allocation to gold, the real problem is availability. The physical metal isn't there. The London market, he says, has been built on layers of leased and re-hypothecated gold, endlessly recycled through the system to sustain an illusion of supply. But as the liquidity dries up, this mechanism begins to fail. His view is blunt. Once the unwind begins, the actual price of physical gold will be far higher than what the paper market suggests. And as for silver, at a gold-to-silver ratio above 80, it remains plainly ridiculous. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
How do you invest in gold? Well, your compliance officer won't give you hell if you buy an ETF. But an ETF is actually quite an expensive way to do it. What you should do is buy physical metal and store it properly. And it'll cost you, basis points, no more than that. But the problem there is that gold and silver are not regulated investments. So you've got a lot of explaining to do to your compliance officer. But that's the best thing to do. I'd sort of calculate, if you look at the actual level of exposure at the moment, portfolio exposure to gold around the world, and we're talking about an estimated 300 trillion of portfolios total around the world. Their exposure is about 0.5%. If you're going to increase it by only 1%, at current prices, that's 25,000 tons. Where are you going to come from? It's just not there. So I think we're in a situation which, we've already beginning to see a squeeze in the market. And this is something Andy is probably a lot closer to than me. But when I saw all that stuff going out of the Bank of England back in April, the trucks backing up and you're being told, come back at the end of the month. I started thinking, that's basically leased gold, which before then was just remaining in the vault. Okay, it was a book transfer. So the Bank of Finland would own, say, they would lease, say, 50 tons, and it would be leased to XYZ. It was a book transfer because it would remain in the vaults. Now it's disappearing. If I was a central bank, and I don't think I'm stretching my imagination too far, I would think, hold on, I don't think I want to get involved in this leasing game anymore. I think I'm going to stop leasing, because it's now getting more important that we actually have possession of our gold, or at least have it stored without any encumbrances, such as out on loan to someone else, leased to someone else or whatever. So I think that's drying up the whole of the mechanism, if you like, in London. So what I'm saying is that, it's all very well turning around and saying, put 20% of your portfolio in gold. It's not there. And worse than that, the liquidity actually is drying up. The liquidity that's keeping the paper market going, because, this leased gold, it gets hypothecated, re-hypothecated, re-hypothecated. It just goes round and round and round. And it's like spinning plates. You used to have those chaps on the stage with spinning plates on the end of. And you'd go around and get dozens of these things spinning, and see them starting to fall, to get around and sort of get them going. That basically is the gold leasing game, and a lot of this gold has actually gone. It's disappeared. The leasing game has been going for so long, and of course, the thing about silver is that it's always been the poor man's monetary metal, as it were. And, if they think they've missed the gold boat, they'll go and buy silver. So, and there's not a lot of liquidity there. I'm seeing that in China, stocks have dropped to well under 1,000 tons in the SHFE. This squeeze is evident again. And I see that this morning there's a small backwardation between spot in London and COMEX. So that's returned after one day. I think it's one day of normalizing. So the situation, I think, when it comes to the availability of metal, is not there to accommodate investment strategists turning around and saying, well, you should up your gold content. And I think what it means is that you should actually buy it sooner rather than later, sooner before all the other guys. And my strategy, I think, would be, get gold now, because there is absolutely no doubt it won't be available at anything like these prices once these things happen. And silver, incidentally. Well, I know it's not a monetary metal, but, if you look at a gold-silver ratio of, 83, 84, I mean, this is plainly ridiculous. It should be 30 or lower. So the two monetary metals, I think you take a position in those, and then you've got to play the end of the bubble. And that basically means lightening up on rising prices from here, on tech stocks in particular. Bitcoin, incidentally, correlates beautifully with the Magnificent Seven. So if you've got that as well, I would get out of that. And when it comes to bonds, well, you don't want to be invested in duration. I know that insurance companies and pension funds look at matching, if you like, duration with their liabilities, of course. But as much as possible, you want to go short on duration. I think that's desperately important. And then what will happen, I think, at the end is that your position in gold will actually rescue all the other positions. And that's where you've got to get to. You don't have to have a huge amount of gold to get that. You don't need 20%, but get in there because, as I said earlier, if you look at a 1% increase in gold in global portfolios, that equates to a demand at current prices of 25,000 tons, and it is not there. It's quite simple. So, if you leave this one, you're going to miss the boat.
Veteran economist Alasdair Macleod paints a sobering picture of what's happening beneath the surface of the global gold market. He explains that while investors are being advised to increase their gold exposure, the physical metal is not available. Liquidity in London's paper system is evaporating as central banks pull back from leasing, unwilling to risk losing control of their holdings. The re-hypothecation cycle that kept the illusion of supply alive is breaking down, revealing a system built on paper promises rather than real metal. He warns that once this unwinds, gold will be unobtainable at current prices. Silver, too, remains grossly undervalued, with the gold-silver ratio still near 80, a level he calls plainly absurd. Let's get into the interview.
Yeah, it is interesting that the first time, certainly during this fiat currency life, which is now, 54 years and counting, we actually have major investment managers, or rather, I suppose, investment strategists turning around and saying you ought to actually allocate, 5, 10, 15, 20% of your portfolios to gold. The thing that's interesting is that these big banks, they've got massive amounts of funds under management. And, we're talking about the sort of net worth individual portfolios. The sort of thing I understand people like Goldman's have got about $1.25 trillion under management, Bank of America another trillion, trillion here, trillion there, and all the rest of it. And they got nothing. They've literally got no gold in there at all. They don't know how they're going to get it. First of all, when Bretton Woods ended, there was a big propaganda effort by the US Treasury to persuade everybody that gold was no longer part of the monetary system. Now, I think it's important to know that that actually goes against common law. Common law is that gold is final settlement and everything else is credit. And this goes back to the first set of laws produced in Rome, which were at 448 BC. That was refined by jurors in the following decades, following centuries, and then incorporated in Justinian's Pandex. And of course, out of the Roman Empire came all the countries, the European countries, from the Urals, or if you like, from Russia all the way through to Portugal, who went out and colonized the world, including the great US of A. So everyone's common laws outside China and so on and so forth, which is somewhat different. Everyone's common laws had the same thing, and that is that physical metal, gold, silver, was final settlement and everything else was credit, including fiat currencies. That's the important point. They are credit. And the value of a fiat currency depends on two things. Firstly, the quantity of its issue, and secondly, the faith that its users have in the value of that currency. And the problem is that fiat currencies always come to an end. And we've had this regime now, based on propaganda, no more, for 54 years. It's coming to an end, in my view. Why is it coming to an end? It's coming to an end because governments use fiat currencies always as a means of accumulating debt without having to, if you like, keep the value of that currency tied to gold, which limits, it cramps their style. It really does cramp a government style. So you always find that these fiat currencies end in a massive mountain of debt. That then collapses in terms of its value or counterparty or bankruptcies or whatever. And so are we close to that point? I think we're getting pretty close to it, is my view. And when it happens, everything changes. Absolutely everything changes.
Veteran analyst Alasdair Macleod warns that the 54-year experiment with fiat money is nearing its inevitable end. For the first time in this entire era, foremost investment strategists from the largest banks are quietly suggesting portfolio allocations of 5 to 20% to gold, a signal that the monetary tide is turning. Yet, he says, these same institutions collectively manage trillions of dollars and hold virtually no physical metal. The deeper problem, he explains, is that fiat currencies are not money but credit, their value resting solely on confidence and the pace of issuance. And like every credit system before it, this one is drowning in debt. When faith finally collapses, everything changes: the financial order, the reserve system, and the definition of value itself. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.